you probably need shorter time frames as well when you're kind of thinking about when you're getting in and out. So, in that sense, I think the macro is very important in terms of how you think about your approach. Again, depending on kind of your goals and your risk tolerance as well. So, another point I would like to make is just that, the stock market and crypto, very high correlation. The crypto has much more beta. It moves much more volatility and kind of bigger moves than you'll see in the equity market, but they're highly correlated. You can go back and look at it for some time now, and you can see they move together. So again, the macro builds into the kind of how equities, what the sentiment is, and then kind of crypto pulls right into that. So I have a background in the bond market, and that's kind of where my career is. It is by far kind of the biggest global market. You would say most of the smart money, most of the institutions play heavily in the bond market. So, as I've seen over the years, the bond market tells you a lot. It tells you a lot of what kind of the smart money thinks is going on and thinks is potentially going to happen over the years and months ahead. So, so we'll get into a little bit about of what the bond market is telling us. And then, we'll look at some of those kind of specific events that are coming up. I think let's start, look at some of these bond market indicators. I'm going to take a couple screenshots here and post them into, I guess we'll put them in office hour chat. The first one I'm going to post in here, I would say, is my single favorite economic indicator, and it's very forward-looking, which is what's so great about it. If I was going to watch one thing to tell me where things are headed, without question, it would be this particular indicator, which is simply the yield curve. This looks at the difference between short-term rates and long-term rates. There are periods, not many, where short-term rates are higher than long-term rates. This happens to be the period we're in right now. And you can see without fail, with a very high degree of probability, when the yield curve is inverted, inevitably over the next 1 to 2 years, a recession follows. So this is why I have such high conviction that a recession has not happened yet, and it's still to happen in the future. Now, things are slowing down a little bit. I actually thought we'd likely be in a recession by this time. It just doesn't appear to be the case yet. We have, an economy that is clearly slowing, but we also have a job market that's really hanging in there, despite some of the losses we see over in the tech space. We still have the job market that's hanging in there. We're going to get a jobs report on Friday. I would say this is probably the single biggest economic news of the week, despite the Fed meeting on Wednesday. And which we want to see. We want to start seeing that job market deteriorate more than it has been. But again, I just point back to this particular this indicator. When I see the yield curve move back into positive territory, that means short-term rates are lower than long-term rates. It likely indicates we're at the precipice or potentially in a recession. Now, I think that is the time to really get more aggressive because things are being cleansed. You're going to see prices likely fall. And to me, that would be the time to get more aggressive. But you can see here how deep this inversion is compared. Really, you have to go back to the 80s, the last time we had high inflation, to see a yield curve as inverted as we've had now. So again, I know the last month or two has been very positive. I actually don't see anything to disrupt the positivity in markets over the very near term. But again, this indicator alone gives me high conviction that we have not gone through the worst of it yet. And so what does this mean? I think if you're kind of in this space, especially kind of people in MVHQ that might be trading pretty frequently, again, doesn't mean we can't have periods that are very positive. Doesn't mean you cannot make money during these periods. I just think you have to be really tight with kind of your approach, and don't get caught into any kind of long-term longs, basically, because again, I don't think we've seen the worst of this, and this particular indicator, pretty strong indication again that we have not seen that. If you want to look at how equities respond to those kind of periods of recession, I'll drop another indicator in here.
While you're doing that, can I ask you one question real quick, Shaggy?
Yeah,
This
please,
can be
go
your
ahead.
first. Cool. It's your first guest question here. So you said a second ago that you don't think that we're in a recession yet. I was just curious, how do we know that we're in a recession? Like, what are the most important metrics to look at to know, like, yes, we are now in a recession?
Sure. Yeah. I mean, inevitably, you don't know into your recession until essentially after the fact. But the indicators I would watch, employment. It's a little bit of a lagging indicator, though. So by the time employment gets into negative territory, we're probably already in a recession. GDP, of course, is the traditional measure of a recession. When that's in negative territory, you're in a recession. But again, a lagging indicator. So, if you want to look at more forward-looking, the yield curve is my best forward-looking indicator, and then you can also you can get a sense when you start to see a bigger pickup in unemployment announcements. You start to see forward guidance in earnings being weaker. Things like that. But inevitably, it's extremely difficult to say the recession has started, even when it has started. Ultimately, you usually don't know for about 6 months or so, looking back, to say that was the start of the recession. But to me, this just doesn't feel like it. And like I said, I look at that indicator, that yield curve. I would expect that to start turning back up. So at least start to flatten and move into positive territory in advance of a recession. As you can see, that happens almost every period. And so what would make the yield curve do that? It's very simple. The Fed cutting interest rates. So this kind of loops back to the Fed, why the Fed is so important, why the Fed has essentially pushed us into this slowing economic period because they needed to fight inflation. And so what will take us out of it? Very simple. It will be the Fed cutting rates. So once the Fed starts cutting rates, to me, that's a very bullish signal. And again, I would be much more aggressive, much more willing to hold positions for longer periods of time once I saw that the Fed was cutting rates. Unfortunately, it would appear that we could be a year away from the Fed cutting rates. Ultimately, it will depend on how the data comes in, how things progress. They could move sooner if things deteriorate faster, no question about it. But I think the message we're going to get from Powell on Wednesday, when they raise the federal funds rate by another 25 basis points, is that, listen, while we may be getting close to stopping raising rates, we are not close to lowering rates yet. And what do they need to see rates to lower? They simply need inflation to come down, continue to come down. Now it's coming down. It's moving in a positive direction. I think we'll continue to see it come down. But does it come down far enough to make the Fed happy? The Fed's looking for a 2% PCE. It's a little bit a different way they look at inflation, but they're looking for a 2% rate there on inflation to meet their targets. So I think we're quite a ways away from that. If things would deteriorate faster, we would get to that point quicker. So, honestly, if you are kind of looking to get past kind of this, I will say we've been in a rougher period now for 9-10 months. If you're looking to get past this, you want things to see things deteriorate faster. You want to see more unemployment. You want to see the economy slow. You want to see all the things that would cause people to tighten down and thus cause a recession sooner rather than later. And so, those are kind of, when we look at the economic indicators right now, bad news is good news, right? It's not always like that, but that's the period we're in. The market wants to see bad news. We want to get through this as quickly as possible. And ultimately, we'll just have to see how the data progresses. But I absolutely would want to see that yield curve, that first graph I showed, turn around there before have a little bit more confidence that we might be able to get a little bit more aggressive in terms of investing for longer periods of time. You can see that second graph is it's a graph of the total stock market it's a full cap index. And you can see the recessionary periods. I mean, risk assets turn lower, stock markets turn lower. The stock market doesn't go up into a recession and through a recession. So, we're definitely here in a period. We're well off the highs. Obviously, ETH was over 4,000. Equities were much higher. We're well off the highs. We're in a bear market. We're chopping around. It goes up, it goes down. But I don't think. I personally don't think a recession has started. It could have. I don't think it has. I don't think we've seen kind of the washout yet that I would expect. So doesn't mean you can't make money. Not at all. Just again, I would be somewhat cautious of overextending, especially into positions that you're going to hold for longer periods of time, given the macro. So when the macro changes, I think that all changes. I think when the macro changes, you can get much more aggressive. You can hold for longer periods of time. You can wait for things to play out. So again, that's to me is why kind of the macro is so important. What else is going on in the macro? Again, I told you this is all about the Fed, what the Fed's doing here. We are having the fastest cycle of rate hikes since the 1980s. So it's rather extraordinary how fast the Fed is moving, what the Fed does, and by the time it hits the economy, it takes 6 to 9 months. So you think back, we're only hitting kind of what the Fed's done through the end of the summer. Everything the Fed did in the fall, the 75s, the quantitative tightening, I'm going to touch on this in a moment, is all still to hit the macro, to hit the economy. So again, there's the old adage, don't fight the Fed. Markets over the last month or two seem to have forgotten this a little bit, but ultimately I suspect they will be reminded. This has worked decade after decade. You don't fight the Fed. When the Fed is providing liquidity and easing, you go all in, right? So the Fed is, they've done this quantitative easing where they're buying bonds, they're pumping liquidity into the markets. That is a time to just play along with the Fed. But what we have now is the opposite. We have a Fed that's tightening and also importantly, quantitative tightening. So they're actually taking liquidity out of the market. It's very difficult to see a continuous flow of assets or continuous flow of capital into risk assets when liquidity is being drained from the market. And this is what we're having. The Fed is draining liquidity. So again, you have to look under the surface what's going on. And again, the same trends persist there. And, just don't fight the Fed. And we're starting to see some deterioration in some of the weakest spots. So you're seeing some real deterioration in kind of used car debt. You're starting to see savings be depleted and credit card spending go up. So there are a lot of the indicators that you would look for to say that things are definitely slowing. There is no doubt things are slowing. If we are in recessionary territory yet or not, I don't think we are, but it's not impossible. So that's how I look at things from kind of a macro perspective. So maybe I'll just pause there, talk for 15 minutes, and love to take any questions people might have.
Yeah, absolutely, man. Great insights so far. I'll just grab a couple because we do have some guest questions piling up here. Definitely want to make sure you can get through all of your spiel here. But one question Poppy asked is, do you think studying the macro economy is something that you recommend checking daily, weekly, monthly, or quarterly? And then what are some sources to stay updated? So just, how close to the pulse are you? And what are some good resources for us?
That's a good question. I guess it depends on your investing style. I think that personally, myself, I'm a bit of a long-term investor. I invest somewhat cyclically, which is kind of looking at where we're at the business cycle. This yield curve indicator I showed, it doesn't change that often. Look at it, monthly or even quarterly. For those of you, which I imagine most of you, kind of moving day to day, trading day to day in the markets, the overall macro picture isn't going to change that much from day to day. But what is important, I think, is understanding and looking at what are some of the variables that might move markets that week. So like this week, you have the Fed meeting. So I would be somewhat cautious, at least, taking long positions in front of that Fed meeting. I think, not that I expect any surprises. The Fed's going to do a quarter. It's going to be without surprise, but I don't think the Fed's going to come out with a super dovish message. I think they'll kind of continue their message that they have been giving, nothing new. That's saying that, listen, we're going to stay higher for longer. We're going to make sure we get this inflation thing under control. But, the markets don't seem to want to listen to that so much. So they'll be reminded of that on Wednesday. Again, I don't think it's a huge market mover, but something to watch. And then, of course, to me, the big event would be on Friday with the unemployment report. And these reports can go either way. They're kind of volatility inducers more than anything else. If there's a surprise, markets could really rally or they could sell off. So again, if I was trading, especially if I was trading the cryptocurrency itself, I would be pretty cognizant of those types of events and, be nimble around those. But overall, the macro, like I said, it doesn't change. It's you can look at it monthly or quarterly. You can get a sense of where we are in the cycle and perhaps how you should be approaching it.
And then just real quick, where are you looking? Where should we go? Is there like an official Fed website, or what are some good charts or stuff we can look at?
Sure. There's a lot of good sites out there, for the most part free. The Federal Reserve Bank of St. Louis has a database called FRED, F-R-E-D. If you just go to Google and type in FRED database, this is populated with just an enormous amount of data. So if you want to look at any kind of data, you want to look at any type of trends, CPI, these are where I pulled these two particular charts. In terms of economic market data, this is a wealth of free information. So if you like to look at charts, if you like to look at that kind of stuff, FRED, F-R-E-D from the St. Louis Fed, phenomenal. In terms of some of the tools I use are going to be very proprietary and not cost effective for the most part. But you can get data out there. The FOMC website, it's a good place to keep up to date on kind of the Fed meetings. And, they release their reports there in real time. So in other words, the markets don't get a front run the Fed releases. Just go to kind of the FOMC website, look at the meeting information, and you can get those current releases as they occur. That's a good place to go. In terms of the economic releases, I'm sure there's a good clearinghouse out there. I use Bloomberg. You can probably go to Bloomberg. I don't know how much detail you can get there on kind of the day-to-day economic releases, but I do try to highlight those in my kind of macro updates I drop from time to time. In terms of either the most important releases for the week or those upcoming releases. So, I think if you just stick with those sources to begin with, you'll find more than enough information.
Beautiful. And then apologies, Scott, I'm going to skip your question just for a second here, just because Jeff's slots perfectly into this. So we're talking about indicators and stuff to check. So he asks, what are good indicators to see the Fed balance sheet for watching quantitative easing or tightening?
Yeah, you can just go to that FRED database and look at the Fed's balance sheet, and they will show you. The Fed also, at their meetings, announces exactly what they're going to do in the months ahead. So it's fairly easy to follow exactly what they're doing. Right now, they are removing about $97.5 billion of liquidity per month. Of course, their balance sheet got as high as $9 trillion. So, it takes time for this to be removed from the system, but it also adds up. And here's the thing about liquidity. People don't pay that close of attention to liquidity until you need it. And so, as liquidity is being removed from the system, we're just more susceptible to a shock. That's all. Doesn't mean a shock's going to come. Not necessarily, but it means if there is some type of economic shock, that markets are likely to react perhaps more violently than if you were at a period where the Fed was adding liquidity to the system. So there's the old adage, liquidity doesn't matter until it does. I mean, you guys know this just in trading NFTs, right? Liquidity dries up, you can't sell the thing, right? So it doesn't matter until it does. When you show up to sell it, if all of a sudden the liquidity dried up, well, then the liquidity matters. But it's not that different in the broader market on a much bigger scale. So, but you can follow along on Fred on the FOMC's website, both those places, and get a good idea of exactly what the Fed is doing in terms of the liquidity. I don't expect them, even as they pause rate hikes, to change their quantitative tightening. They should continue to remove that liquidity from the system as for some time, is my expectation.
Awesome. All right. We have a few more questions, but they're a bit more broad and big picture. So if you want, you can kind of just kick back into it. We can maybe save these for the end just so we don't go too far off the rails, if that's okay.
Sure. Yeah. I mean, I don't have a lot more. I mean, I'm happy to take the questions. If I look forward, what am I watching for? Listen, this entire macro, this entire cycle is all about inflation. Inflation got too high. Why did it get too high? It got too high because of COVID. We had shocks to the supply system. We had shocks to the labor market. We had the government pumping in a tremendous amount of money into the economy. We had the Fed pumping a tremendous amount of liquidity into the monetary system. All that adds up. It's simply too much money chasing too few goods, and you get inflation. That simple. Inflation is a big problem. Inflation throughout world history is something to be avoided. Europeans, essentially, that's what led to World War II. It leads to wars. It leads to tremendous strife, tremendous hardships for populations. So, listen, inflation is something to be avoided at all costs. The Fed knows this. And inflation simply got far too hot. They were expecting it to moderate. It didn't moderate. So, we must fight the inflation problem at all costs. And that's what's going on now. So it's simply the Fed starts doing the opposite. It starts taking money out of the system. We're looking probably at the government, especially now with split in Congress. They're not spending. In fact, I think you're going to see probably some negotiations around cutting spending. Whether it's around the debt ceiling or additional spending to keep the government open at some point in the future. I think you'll see the government actually cutting spending, or at least slowing down the growth, hopefully. As those excesses get drained, people, face difficulties. They lose jobs. Companies cut back. But this is all necessary simply to reduce the amount of money out there that's chasing those goods and bring inflation down. If you don't bring inflation down, you have, like I said, a far worse set of problems. So this is what's happening now. So it's all around inflation. So, you really want to watch the inflation numbers. This is probably what's going to influence markets the most over the near term. We've seen inflation coming down. It's going to continue to come down. But here's the thing. The Fed's goal is 2%. So we were at 8. Now we're at 7, moving to 6, moving to 5, right? We'll move to 4. How far lower below 4 do we get? Can we get into 3s? Can we get into the 2s where the Fed wants it? That last mile is going to be probably the most difficult. So this is what we're going to watch. Nobody knows. We could all have guesses. The Fed has guesses. The reality is nobody knows how quickly it's going to come down and how, when it's going to reach the Fed's target. So, the Fed's not going to commit to any certain thing, but this is the most important thing to watch in the near term, or simply those inflation numbers. So what are we watching? We're watching that CPI on the 14th. Very important. Come out every month. The jobs, very important, because as people lose jobs, they have less money to spend. Inflation comes down. So you'll watch not only kind of the job market, but also, those with the job market, you get, the average hourly earnings. Are people making more? Of course, if people are not making more, if you start to see raises and increases in salary come down, well, it would likely lead to lower inflation. So these are all the kind of metrics. And when I said bad news is good news, it really is right now for markets, because this is all about inflation. We have to get inflation down, have to get it stabilized, have to get some of the excess out of the system so that we can then start anew. And so this is really, again, kind of what, to me, from a macro, a big picture, I'm watching. And over time, again, I don't think this will dominate your day-to-day trading, but again, thinking about how to position over longer periods of time, and maybe when to hold on to positions a little longer, be a little bit more aggressive. I do think the macro is fairly important, understanding just where we're at in the cycle and where we're at in the macro. So let's take a few more.
Yeah, absolutely. So I want to go over Scotco's question real quick, and I think you've kind of snuck in your thoughts here. I think you've actually made it very clear. He asks, what are your thoughts on the recent rally in stocks? Tesla up 60% in a month, for example. And then he also asks, what effect does recession have on home values? And it sounds like you're saying don't fight the Fed, and that's what people are doing right now, pumping these stocks, right?
That's right.
Yeah. I mean, listen, some of the biggest rallies we've had in history come during bear markets. I mean, so it's not unusual at all to see some really nice moves higher, even though the macro overall isn't good, in my opinion. So I don't think too much of it at all. I think that, I'd be selling into rallies personally on the equity side. When you get nice gains, especially over short periods of time on the NFT side, I mean, great, take the profits. I mean, I just don't see any real risk right now in taking profits, trading, kind of clipping. Again, I don't have a strong, unless you have a really long time horizon. Some people, maybe you buy a piece of NFT art or a particular PFP or something that you're like, listen, I'm going to hold this for the next 5 years. Maybe you don't really care that much if it goes down over the near term, right? So sometimes just you have to think of your approach and your mentality there. But again, this rally, not unusual at all that we would see in bear markets. We're in a very good seasonal period here early in the year when you have a lot of new 401k money and a lot of new positioning come into markets. I mean, it all kind of lines up. Again, I think this could continue a while. I don't suggest that, this nice rally we have is about to be over. That's not what I'm suggesting at all. I look over the longer term, and I just don't believe that we've started a new overall bull market. I don't believe ETH is going back over 4,000 here, trying to hit new highs. I don't believe the stock market is going to hit new highs. I don't believe Tesla is going to hit new highs. Right? I mean, is it up? Yes, but you've got to think about where it is from the peaks. It is still way down. And again, I don't think the macro is set up for us to go back there yet. Do I think we will one day? Yes. I mean, all bear markets end. They always have. And out of them comes new bulls and new highs are hit. So, I don't, you just have to be patient. These things take time. I think a lot of time in the NFT space, there's a lot of impatience. Right now is not a bad time to be impatient. Take the profits, take the gains, right? I just don't, I think that's how I look at it, what the recent rally is, and think about kind of where we are in the overall picture.
Yeah, it makes a ton of sense. And then another question I wanted to ask you, it's a bit of a doomer topic a little bit, but I at least want to pick your brain while we have you here. You mentioned several times that bad news is good news, right? Like people need to lose jobs, companies need to go out of business and cut spending and all of the like, just so we can hit the bottom and you build up from there. Could you talk about maybe a potential outcome where the Fed does not stay as hawkish as they are, positioning themselves right now? Like maybe they think that the job is done and they ease rates too early. Could you maybe talk about like some of the outcomes that could happen in that case, like maybe stagflation or stuff like that, or do you have any thoughts there?
Yeah, I mean, first off, I have a strong belief that the Fed will not do that. They've again, Powell is a student of Volcker, and I have a strong belief they've learned the lessons from the '80s, and they will not do that. So that's first. Now, if they would do it, essentially in the '80s, that's what we did. They took their foot off the gas too soon, and inflation reemerged, and Volcker had to come in and really put the brakes on. And we're talking about raising the Fed funds rate to double digits. Talk about some nice yield farming when you can get that kind of yield on cash in short term. You can imagine, why would anybody invest in anything else? You just put all your money and clip the super high coupon, and thus there's no money chasing any goods anymore because everybody's sitting over collecting those really sweet juicy rates. And of course you have a pretty significant recession, but of course also that helps bring inflation down. So, if the Fed would quit too soon, I think, and you saw a reemergence of inflation, well, that means the Fed likely going to have to go even harder. Probably would not be a great outcome. I just am out of the belief, though, that the Fed will do that. Again, I have very strong conviction that the Fed is going to, if anything, err on probably doing a little too much to make sure that this inflation problem is solved, and they don't have to come back and work on it a second time. That would not be a whole lot of fun.
It might be outside of this conversation, but do you have any thoughts on just like the talking heads and like perma pumpers that are like, the Fed's going to pivot just day in and day out for the past like 3 months? Any thoughts on them?
Well, I mean, here's the thing. You turn on the TV and get opinions on both sides. I will also say you have to remember, when you're looking at Twitter, you're looking at TV, they're in the business, for the most part, of getting eyeballs. So what gets eyeballs? Think about it. They're like having a way out of consensus view, or having an extremely positive view. Anything that gets people to read their tweets, to turn on the TV, right? I mean, then they're making money, right? So they're not really as much in the, I would say they're more in the infotainment business more than anything else, right? So just take it with a grain of salt. I would take a grain of salt. Anything when you're looking at markets, you're looking at investing, take with a grain of salt where you're getting your information, and again, how those people are motivated.
Damn, has Kramer been engagement farming us this whole time with his bad takes?
Yeah, of course. I mean, he is. I mean, he is an entertainer. I mean, he's entertaining to watch. He is. I wouldn't go to him for any real kind of stock investment advice for the most part. You can find far better advice out there than he's delivering, but you probably won't find it with the same pizzazz and excitement. So, again, you got to just think of what their job is. Their job is to entertain you, to get eyeballs. That's what their job is.
Absolutely. How do you stay sane during bear markets and like low liquidity situations? Do you just does it not affect you much, or do you get bored, or do you just stick to your convictions? Like what do you do when you have all this extra time?
Oh, well, I mean, I'm actually quite busy right now, busier than I have been in a while. NFT wise, I don't know. I just have it's not a full-time job for me. So I totally get if you're spending, this is your primary source of income, you're spending a lot of time here. It's a little bit different game than the game I'm playing. I'm just not I'm just not in it for that per se. Don't get me wrong. I love to make money. I love to flip an NFT and make money, or trade an NFT and make money just like everybody else. But for the most part, my kind of savings, my wealth is not in crypto or NFTs. Quite frankly, it's much more in kind of traditional means, and it's on cruise control for the most part. I do all the things that work over long periods of time, which is asset allocation, diversification, rebalancing, dollar cost averaging. Is it exciting? No, it's not exciting. But it is. It's effective, and it's profitable, and it builds wealth over long periods of time. For the most part, the rest of my activity, I do a lot of things. I travel a lot more when markets are slower. I'll, maybe play some more golf here or there. I do a lot of things outside of NFT space to fill my time. So I think I'm probably maybe a little bit more of an outlier, especially within MVHQ around that, in the fact that, I don't have to have, as much activity and liquidity. I'll just take a break and do some other things.
Yeah, we need constant stimulation, Shaggy. Yeah, you're right. That was not an exciting answer, and that's probably the least degen shit I've ever heard up on this stage. But that is why we love you, Shaggy, and that's why we're so happy that you're here today. I'm kind of just going to dig into my bag a little bit here. I'm kind of just searching for questions. Our talk is called "The World Economy and You," so I'm curious if there are any, overseas big, impacts that in relation to U.S. economy that you're watching. Like, are there things that we need to be monitoring internationally, or is most of this just happen here at home?
Well, sure. The old adage is like the U.S. Sneezes and the world catches a cold, and to some extent the U.S. Clearly kind of dominates world markets, but China is very important to watch. And I think there's some positive things going on over there in the sense that we finally got over or done with this COVID nonsense. And they're able to, like the supply chains are coming back. Those are positives. But it's still something to watch. You watch China pretty closely. There are a lot of geopolitical things going on right now that, also worth watching. But I will say this, for the most part, like geopolitical, for the most part, doesn't impact markets for very long. So, if there is, a new bombing in Iran or some kind of strife with China or in Ukraine and the markets sell off, generally that's a buying opportunity for the most part. Those geopolitical events, they just happen. They've happened through all of history. It's nothing new. It feels big and important at the time, but for the most part, it's not as big of a deal to markets. So, but there's always things to watch. But I would say China is probably the most important other economy in the world, and to kind of see them get out of the COVID, get supply chains back, get to growing again would be overall a positive.
Gotcha. Sounds good. All right. If it's cool with you, we're going to open the book of Shaggy here for a bit and ask some personal questions here. Skako asks, are you long-term bullish on any NFC projects?
Yeah. Do I own some things long-term? I do. Am I bullish on them? I view it almost like this, because I don't know where long-term this current iteration of NFT projects ends up. Spending, $100,000 on an 8 picture for the long term, I don't know. Could it turn into this great global IP brand and, just have enormous returns? It absolutely could. But it also could turn into, 10 years from now, somebody is saying, why am I spending, $20 on an 8 picture, so you don't know. So I like to think of, again, because this is not a major part of my kind of portfolio, I like to think of NFT and NFT projects as like a moon bag, right? So I do own things long-term, just in case they do go up. My guess is that like the current iteration of NFTs is not kind of the future, right? NFTs and the blockchain, I do think, are the future. I'm just not sure that the current version is. But nonetheless, like I said, I have moon bags. The one I personally have been investing in the most lately is is the treasury ecosystem. I just love what they're doing over there. Now, is it a long shot? Absolutely, it's a long shot. It could be worth absolutely nothing a couple of years down the road. I understand that, but there's also potential it could turn into something very, very big. And so again, I think of it as a kind of a moonshot there. I do like Yuga and their ecosystem. I'm not sure the current prices make a lot of sense, but nonetheless, long term, it's got as good a chance, if not a better chance, than anything else to kind of be that moon bag, right? So, but that's how I look at NFTs in general. I just don't count on them being uber valuable in the future. Some of the other things, like I said, I've gotten pretty heavy over into the Magic ecosystem. The other things, I've just really been vaulting like art that I like. I think it's something that will stand the test of time. But again, you're betting on the artist becoming well known, growing, expanding. Again, a bit of a moonshot for sure. The artists that are popular today, do they have the staying power? Do they last? It's a guessing game at most. But at least then I have some pretty pictures that I at least like sitting in my wallet. So that's how I view it. Those would be kind of the ones that I currently see the most promise.
Love it. Yeah, thank you for that. It's a very, very measured approach with the moon bags. Wouldn't expect anything less. Jeff Yasko asks, can you tell stories behind your best macro trades and the best macro lessons so that we can learn from them, or worst, if you prefer?
Yeah. So, I mean, macro wise, I'm just trying to think back. I've been doing this a long time, mostly on the fixed income side. And, fixed income to an extent is a bit of a boring asset class, but you want it to be boring. But just recently, got very aggressive on buying what we call in the fixed income side duration. It's actually longer term maturities back in October. Now you would say at the time the 10-year treasury was yielding about 4.25%, and short-term rates were there, or actually a little bit higher. So you say, why would I want to lock in, 10-year a 10-year stream of interest payments at 4.25% when I can make even more in short term? Well, my belief is that at some point, probably within a year, maybe a little bit longer, the Fed's going to start cutting rates. And when you're getting 4.5%, 4.75%, 5% on the short term, it goes away quickly. And so, we locked in, actually very aggressively locked in a lot of long-term exposure at that 4.25%, and it's performed phenomenally well. It was just kind of an obvious trade to me, just again, being kind of more of a student of fixed income and seeing kind of where things were headed. But, I take, especially in my day job, I take a much more measured approach. Like, I'm investing, we're making kind of locking in kind of good bets, but I don't get out over my skis on anything. I don't ever get too aggressive. I live by kind of diversification and asset allocation really religiously, because again, investing, it's different than trading though. Investing is, but again, if you've accumulated assets and you would like to grow them and grow your wealth over time without spending a tremendous amount of time micromanaging them, asset allocation, diversification, they're your best friends. And, it's just tried and true. You will grow your assets over time.
Okay, I'm going to do something just to try and make you uncomfortable here, because it sounds like diversification is key, right? It's a really important aspect. So this question is to go against that directly. If you could pick one asset as the best store of value, just like the flattest thing ever, what would it pick? I'll tell you mine. I would pick Costco hot dogs. What are your thoughts? Your thoughts?
All right, store of value. Yeah, that's if you just one. If you're just making me pick one, well, now I'm not diversified, but in terms of storing value, I mean, honestly, over time, the S&P 500. I mean, is it volatile? Yes. Can you lose? Can you lose? Yes, but you're going to over 5-10 year periods. You're going to make very good returns, very predictable returns over those periods, and at least that's a well diversified index. A lot of people like to think about gold. Gold stores value. I don't know. You can really make a lot on gold, but in terms of storing your purchasing power, okay, that's there as well. And but I guess if I had to pick one place, I would just close my eyes, buy something with a good chunk of money, and know that I'm going to have more money and probably a pretty good return 5 years from now. I would just buy the S&P 500.
Love it. All right. Thanks for playing along with that strange question. Crypto Aqua asks, when would be roughly a good period to start DCAing to get ready before the Fed pivot? So yeah, crystal ball question, just a bit probably, but yeah, what are your thoughts there? I guess what are you looking at?
Yeah. So, I mean, a couple of things. First, I don't think the markets have bottomed. I would, of course, look for that yield curve to move back to positive. But in terms of DCAing, listen, the future is unpredictable. I can tell you what I think is going to happen in the future. Others can tell you what they think is going to happen in the future. There is no certainty that is what is going to happen in the future. And so in terms of kind of getting into the market, I would say there's never a bad time to get into the market if you're dollar cost averaging. Take the amount of money you want to get into the market over the next 2 years, break it up into, ever many segments you want. Let's call it 4 segments, and invest every 6 months. Put it in. What ends up being costly over time is not being in markets, and it ends up that will cost you more over time. Now, yeah, could you put some in and you see the market go lower and be like, I should have waited? Absolutely. But if you're dollar cost averaging in, it kind of takes some of that pain away. And if markets go up, well, at least you got some in, because anybody who tells you they know exactly what's going to happen in the future is just don't listen to them. They don't know. So I guess my question is, when should I start DCAing? Start now. But again, break it up, space it out. The future is uncertain, but it's better to be a part of the future than not.
Yeah, very, very well said. Yeah, I think the beauty of dollar cost averaging is that the average is what's doing the hard work for you, right? You don't have to sit around and calculate and crunch numbers and time your entry. You just kind of average it all out. All right, another question. Farrell Moore says, any book recommendations to help me better understand the Fed/recessions and strategic investing? I personally like Ray Dalio's Principles.
I don't have any book recommendations. My favorite finance book of the last couple of decades was really around the financial crisis, and it was more entertainment than anything else. Around exactly what went on behind the scenes to basically bail out the big banks and avoid utter calamity. That was interesting. But I don't have any great book recommendations. Honestly, any investment book though probably is better and will inform you and teach you more. Will teach you something. So. It's probably a good time to mention too. I mean, these are just my own personal opinions. Like I said, no one's right all the time, and you got to make your own and take your own investment advice, right? I mean, I'm not giving you specific investment advice. I give you good principles to follow. I know things that work over time, but again, not recommending any kind of specific. Securities or investments or anything like that. So just a bit of a disclaimer, but I think I've been pretty good through the whole conversation, making sure not to specifically recommend anything. So just want to double mention.
Sounds like financial advice to me, Shaggy. No, I'm just kidding. NFA, DYOR, of course, always, forever. Got another question here. I know we're coming up to the top of the hour, so maybe we can end things on this one potentially, but it seems like a good one. So Jeff Yasko asks, can you dive into the details of your macro risk management strategy? When is a good time to de-risk out of assets and move to the left of the risk curve? Are you hedging inside of your portfolio allocation? So 3 questions there. Sorry, I just gave them to you all at once. Maybe we can just start with the details of the macro risk management strategy.
Yeah. So, I mean, my dirty little secret is I'm a long-term investor. So what am I doing? I'm rebalancing. So what does rebalancing mean? Well, it simply means if you have a specific asset allocation that you're targeting, and you think of it in the simplistic terms, what percent of your portfolio is in equities, what percent's in bonds. That's like traditional. I think your asset allocation would be bigger than that, could include crypto and anything, but you would have a target allocation, and every quarter, every 6 months, every year, whatever works best for you, you simply rebalance back to your target allocations. So what does this do? This just naturally allows you to sell when prices are higher, because the piece of the pie is moved bigger. So you're selling your winners and rebalancing in and buying those ones that have moved lower. Now, this is just kind of basic blocking and tackling. It's very simplistic, but honestly, I think a lot of times we make investing far too complicated. It is a very simple process for the most part. I mean, we can make it complicated around the edges, depending on kind of specific goals and targets and all sorts of things. But the basics are, to me, kind of what's most important. So, I don't even really have a macro risk management strategy. I don't really de-risk out of my risky assets. I don't move to the left of my risk curve. I don't really hedge inside my portfolio allocation. I just simply have a target allocation. I'm continually adding money to that allocation. So I'm dollar cost averaging in, and then I'm rebalancing on a regular basis. And it kind of does all of this for you very simplistically. Now, yeah, when I look specifically at crypto, where again, I wouldn't call it one of my core assets, and have a little bit more fun in it, and trading that around. Yes, I think of currently, I'm definitely looking to sell those winners a bit quicker than I probably would if the macro is a little bit better. But again, it's on the edges for the most part. So, I'm not as you don't have to be that sophisticated, really. I mean, when you add all this sophistication to things, unless you really understand what you're doing, or have a very specific goal, you're probably overcomplicating matters and spending a lot of times on things that might be better spent. Your time might be better spent elsewhere.
Gotcha. So there's no hedging then, right? Sounds like what you're saying.
I mean, there's plenty of ways to hedge, and a lot of people do it. I just personally don't.
Sure, yeah.
One interesting, you can, like, if you want to make a little bit of income, you can sell covered costs. There's all sorts of things you can do, depending on what fits your style. I just personally don't do it. It's not worth it to me, all the time and effort for what, I don't think is probably going to add too much alpha, add too much return.
Yeah, that makes a ton of sense. Just kind of spinning your wheels in the mud, not really going anywhere, overcomplicating, overthinking about it.
Yeah, I mean, everything I do is like time and effort, right? So got to think about, if I can make a little bit more money, is it worth putting a ton of time into it? Probably not. If I can make a lot of money, yeah, put more time into it. The same applies to kind of my NFT and crypto, right? Because, in the current market, I do think you can make money, but you have to put a lot of time into it. And again, it's just not, I just don't want to spend my time that way currently, because I have a lot of other things, like an IRL job and a lot of other things I'm doing. I can't necessarily spend the effort. Now, when the time comes and, I can see that spending some effort can make me a lot of money, well, then, yes, I'm likely to spend the effort, right? So I always kind of think of that trade-off, the effort versus return trade-off. And I do think it's valuable, though. I do stay in touch kind of in crypto right now, because the space moves fast and I want to be up to speed when I view kind of better opportunities on the radar. So there is some value there to me as well. I don't want to like completely lose touch because, like I said, it moves fast and it is really hard to kind of get up to speed with the markets if you haven't been paying attention.
Yeah, absolutely, man. Fuck, I think I got it backwards. Seems like the more time I spend watching NFT charts and trading NFTs, the more money I lose. So I got it all worked out, though, Shaggy.
Well, that tells you there that maybe, yeah. I mean, yeah, I always think that everything, whether it's investing or crypto or anything I do in real life, I'm like, I always think like, okay, look at the amount of effort I have to put in. Am I getting the return out of it that I want out of it? Because we can spend our time in a lot of different ways. Try to maximize my return on time, because that's the one thing you can't go out and buy or create anymore is time.
Well, if there's one thing I could maximize time-wise, it would be time spent listening to you, Shaggy. This was great, man. I came in here with MVHQ sweatpants and I left in a full business suit. Like, I feel so much more sophisticated now just from listening to you talk, man. So, look, we all appreciate it. We've got a few more minutes here. You can go as long as you want. But yeah, if there's anything that you want to bring us home with or wrap up with or any final messages, please feel free. But yeah, I just want to say thank you, man, on behalf of everybody, because this stuff is really important and there's not really many other people talking about it. So we always appreciate you, man, and your insights.
Yeah, no, I'm happy to. If anybody ever wants to reach out, have any questions, let me know. Happy to help you out. I'd love it. MVHQ, a lot of really, really good people in here. Everybody shares information, which I love. And yeah, a lot of different styles, which is great. I probably have a somewhat unique style that I'm a little bit more, probably not as much of a degen, although I degen from time to time as well, but probably not as much as a degen as many. But I've had my degening days, and those are in the past. I think most you'll find as you get older, you probably do a little bit less degen.
I'm just picturing you minting like one thing and being like, hoo, I've gone degen, I've gone and done it.
That's happened before, yeah. But yeah, so you got to think about, where you are kind of in your, professional life, your personal life, your investment life. I mean, there's no one size fits all here. So, that's all I can say. Do what suits you and works best for you. And, there's so much good knowledge here. I get little bits of information and good information from all over the community. So I appreciate that. And again, happy to share my little piece whenever there's some interest. So thanks again, everyone.